pitch for time and not money, because an investor's most precious commodity is their time. They have wealth and that time is very precious. They probably have 5 or 6 other business interests. It's not like TV. You're not walking into a meeting with your pitch. They've never seen you before. There's wads of cash on the table and you're going to walk out with or without a deal. The pitch is about getting them to book into another meeting because they feel you're a credible option to invest their time in finding out more about.
I think that's a pretty powerful reframe, right? A sales asset where you want to hook people in, pique their interest, and then they chase and want more.
Investors really care about risk, assets, proof, implementation. Founders are pitching about ideas and opportunities and possibilities. And it's like you're pitching the wrong stuff and you're not treating it like how do I hook them in? How do I get their engagement so I can then spend some time with them?
Meet James Church, best-selling author, award-winning advisor, and co-founder of investment readiness business Robot Mascot.
And we did join forces initially, Robot Mascot. It was a design and communication brand agency. And our vision was always to work with pioneers, is what we kind of called our core market.
Their mission, to help founders raise capital the right way.
The biggest barrier to founders raising capital isn't their idea, but actually the way they communicate it with investors, the way they get the narrative across.
So join us on this episode as James breaks down the real psychology behind raising investment for your brand.
If there's one takeaway from your audience, it's raising investment is just a B2B sales and marketing campaign.
How to make investors see your business as the one that they should back.
Your product shares, the audience are investors, and however you approach sales and marketing for your current product, you can apply probably those same strategies to running an investment campaign.
And why most founders destroy their credibility before they've even sent out their pitch deck.
And therefore the founder loses credibility because they clearly don't understand what it's like to operate a business at the scale in which they're pitching.
So whether you're bootstrapping your first product or scaling towards Series A, this episode will completely reframe how you think about funding and storytelling.
If you like those 5 acts, it's all about psychologically, how do we make a message that lands? And it goes back to the psychology of how humans evolve and how we learn to absorb story and narrative.
Hey guys, if you're enjoying the videos, why not consider subscribing? We drop bi-weekly content that will help you improve your business right here on the channel. James, thank you so much for joining me. It's a pleasure to have you on the podcast.
No, absolutely thrilled to be here. Thanks for having me.
Cool. Can we kick off by just kind of, in your own words, explaining what you guys at Robot Mascot do?
Yeah, so look, I mean, we're an investment readiness agency in a nutshell. So essentially our job is to help founders, business owners communicate their investment idea to investors in a clear, compelling way that makes investors want to take some action and convince these investors that their business is the one that they should be backing out of the hundreds of opportunities available. So yeah, in a nutshell, that's what we do.
I think we were connected by Ben Leonard, who's obviously, big in the Amazon and kind of eCom space. Can you just talk through which kind of sectors you guys mainly work with or what industries?
Yeah, so obviously there's a lot of tech, and I use that very broadly, from hardware to software to e-commerce, like Ben, all the way through to some sort of deep tech, AI, you name it, putting satellites up into space to observe the flow of oil from place to place. So I mean, literally all kinds of really cool and interesting stuff. So there's all of that side of things, but a lot of hospitality, a lot of retail, a lot of food and beverage, those kinds of things. I mean, really consultancy services even. So really we work with startups and SMEs, scale ups, that are looking to raise capital, often their first or second round of funding for their business. Our expertise is knowing what investors are looking for, what story, what narrative, what information they want. Our client's job is to understand their market inside out, and those two things combine to become really powerful.
Okay. And then in terms of your kind of background, I know you started off in kind of branding and design. How did you go from that to what is quite a different job that you do now?
Yeah, it seems like quite a leap, doesn't it? From one to the other. So me and my co-founder, both Nick, both started life in brand and advertising. That's how we met. We started working together at brand and advertising agencies. He was a leading creative director at some top advertising agencies in the UK. I was working at some brand agencies as a designer, as a creative. And we did join forces initially. Robot Mascot was a creative agency. It was a design and communication brand agency. And our vision was always to work with pioneers, is what we kind of called our core market. These people with startups and SMEs that were driving things forward, doing things differently, pushing the boundaries outside of the sort of comfort zone. They were the clients we loved working with. And we started therefore doing brand and communication products, helping them sell their products to their audience. And that inevitably led to some of the clients we were working with saying, we need some funding to push this forward. You've done a great job with the website and with the brand. Can you help us with our funding deck? And as a young startup agency ourselves, all money was good money. And we went, yeah, sure. It can't be that hard. We've all watched Dragon's Den. So we did a couple of these just kind of on the fly, just hoping for the best, really. And they got good results. Our first project ended up overfunding by they were raising 300k. They ended up securing 900k. We had some of our advisors who were investors themselves saying the stuff you're producing is incredible. There could be something here for you. So a real niche, because there's a massive problem. The decks we get are terrible. What you're producing is so clear, it's so concise, it's great. I wish every deck looked like this. So that kind of led us on a journey, and we spent 2 or 3 years researching investors, attending pitch events, understanding kind of how the world works, that world works, and realized that, the biggest issue, the biggest barrier to founders raising capital isn't their idea, but actually the way they communicate it with investors, the way they get the narrative across. They're great at pitching their idea to their audience, but an investor is a very different character looking for very different things. And they struggle to translate their message into the language of investors. And we knew as communication experts, we could absolutely solve that problem. So we pivoted slowly over a 3 to 4 year period, pivoted from sort of brand communication agency to brand communication agency that did a bit of pitch deck stuff. And then that really took off. And we ended up completing a full pivot into that we are just an investor communications agency now. We just do investment readiness. We prepare you and your assets for funding. And that's all we do now. That's our real core focus and our niche and expertise. So that's the journey. So it's maybe not too far removed as you think, but and obviously we had to bring in experts around us. We brought in ex-investors, investment analysts, advisors to work with us to build pitch decks, create financial models, build business plans, and we just brought a team of experts in around us who could fill our knowledge gaps to create what we've got today. So that's kind of it.
What was that decision-making process like in terms of, we originally set out to do one thing, we spotted a new kind of potential opportunity to let's go all in on that?
Yeah, it's a good way. I mean, these things kind of evolve naturally, and you almost don't see them happening, I guess, when you're on the inside. It was a period, we were exploring it as a service line, and then eventually that became the main thing we did. And I guess, when I wrote my book, Investable Entrepreneur, that kind of, when that was published, that kind of signified the full pivot complete almost. It was kind of reset Robot Mascot. But I do remember a point at which a decision of sorts was made to certainly explore this in full. So we had 3 or 4 different routes to market, different services we provided, really, if we bundled them up in our original agency. And I remember it was the day of the Brexit vote, the Brexit referendum, and we sat down and said, it was under a big oak tree in a field near our office. We went for a walk, me and Nick, and we were under this massive oak tree. And that's become a thing in the business now. Like when we have a creative session, it's kind of like an oak tree moment. But we were under this massive oak tree and we were just going, shit, things are about to get nasty. Things are about to go crazy. Like, where's the opportunity for Robot Mascot? Where do we focus our time? And we just got the sense that with the events and the things that we've been doing, that with the crash of the pound, with all of those sorts of things, there was about to be a huge influx of inward investment into the UK, into the startup space. That's what we were hearing from the experts, and we kind of thought this could be a good place for us to kind of hang our hat, to kind of say, look, we've got a real niche here. It's an exploding space. This was 2015, 2016, wasn't it? So the startup scene was really exploding in London. There was about to be a huge amount of inward investment because of the price of the pound. This could be a great time to kind of make that pivot and really make that shift. And that was really the moment I remember that kind of said, yeah, we're definitely going to really focus on this and see if we can pivot into this space entirely, or whether it just continues as a side hustle to the main business. But that was the moment, I think.
Okay. As someone that had kind of grown up professionally, more focused on the branding and the design side, was it hard to turn away from that? Because maybe as an outsider from my perspective, that's kind of your identity and, who you are as a person. Was that difficult from
I
that
don't
perspective, the decision?
think so, because for us it was about solving communication problems, and this still involved a level of design. It still involved a level of creativity, certainly through the pitch. The pitch work is a copywriting and design job, much like creating a sales pitch or a brochure or a website to sell a product. So it was still very much a communication problem. And then what we discovered, so we started with just doing pitch decks, and our clients were 10 times more successful at raising investment as a result of that, which was great. But when we were asking for the information to create those pitch decks, as we became more knowledgeable, we realized that a lot of the founders didn't have the information we needed. So we extended that package of service offering to kind of business planning and financials to really get the stuff we needed to create a great pitch. That's when we started bringing experts who really understood financials and business plans for startups. And our clients went from 10 times more successful to 40 times more successful once we started to do that, because you can also, if you can tell a great story, you can get a meeting with an investor, but it doesn't mean you're going to close the deal. So we focused then on this, and it turned out really, again, it was a bit of knowledge, knowing what investors needed to see, but really it was communication. Again, it was designing the financial model in a way that is easy for investors to pick up, adding in an executive summary as a sort of a Word document to that financial model that kind of articulated the argument for investment, the investment narrative alongside the spreadsheet, looking at the business plan as a communication tool, like a proposal when you're making a sale. And if we applied everything we knew so our experts were producing financial models and business plans, but if we applied our communication skills to those and kind of said we need to present them in this way, we suddenly got this massive uplift on what others in the market were doing as consultants and advisors. And that's what gave us this huge edge, was that every step of the process, it was like, this is a sales process, right? We're just switching the product to your shares and the audience to investors, and we're now just selling your shares to investors. And the pitch deck, the financials, the business plan are just the proposal documents you would use in any other B2B sales process. And we just need to treat them as that. And if we treat them in that way, and we have to communicate this great offer to investors at every step of that journey, and I think that's why it wasn't such a big leap in our head, because despite it being on the surface extremely different, it's just applying communication strategies to things that people are already creating. And that's what gave us that edge, I think.
Okay. And you've mentioned a few parts of the puzzle there, but can you just talk to what it is you do for brands and for clients today?
Yeah, so essentially we take them through a process we call Pitch Ready. And the Pitch Ready process is about really preparing these critical funding assets for investors, for founders to present to investors. And through the process of creating these assets, leveling up the founders' understanding of what an investor is looking for and giving them the language they need to go and hold up to investor scrutiny. So we often say kind of the assets themselves, while extremely useful, are a byproduct of actually leveling up the founder and getting them ready to actually go into the dragon's den, as it were, and kind of be under that scrutiny and have all those questions thrown at them and being able to hold their own under that scrutiny. But the outputs are essentially a business plan where you work with our team to kind of put together an investment narrative around your business case. A financial model, which would be sort of a 5-year P&L cash flow balance sheet of kind of what funding does to your business and what kind of returns it could generate, and then a clear and concise pitch, 15 to 20 slides, that really nails the communication clearly, succinctly, articulately. And we know that once founders have been through that process and they've got a solid business case and it's presented in the right way, the pitch decks that we send out to investors get 2.5 times more time spent on them than the average pitch deck, and 6 times as many investors make it to the end of the deck rather than dropping out halfway through. So when you add that layer of communication on top of the things that other consultants might be doing or founders might be producing themselves, you get a huge uplift in conversion rate. And really, this is conversion rate optimization. Any founder can write a business plan, produce a model, download a template. They may not know exactly what they're supposed to be doing, but they could do it. We see this as very much increasing your conversion rate, leveling those things up, turning that web page from something that converts at 2% to 3% to 4%, so that the same level of investment in terms of outreach to investors delivers a much higher yield and a much higher return. So that's really the way we approach it, and it's through the development of those three assets through that pitch ready process.
And how are you kind of going about distilling the message down and making it more appealing to investors? Like what's the macro theory behind what you guys do?
Yeah, well, I mean, when it comes to the business plan, it's about making sure it's consistent across the key parts of the business. So go to market strategy or growth strategy versus hiring plan versus R&D investment, and all of those things. Does that all add up? Does it make sense? Is there a clear and believable kind of short and long term implementation strategy here that makes commercial sense? What's the commercialization strategy for this? How do we demonstrate product market fit? All of those key things. So it's sort of going through all of the key things that an investor would want to know and making sure that it's credible, making sure that it's consistent. Then when it comes to the financials, I mean, again, it's about credibility. It's about making the founder appear credible. Are they hiring enough staff through the forecast? Are they investing enough in R&D throughout the forecast? Is their budgeting right in the early years? Is their growth expectation considered reasonable but also ambitious in the later years? And this obviously changes massively from business model to business model, sector to sector, but it's about making sure that, for argument's sake, let's say you've got an e-commerce or a SaaS business, a SaaS tech business. You might expect a typical SaaS technology business to earn around 30% EBITDA margins. Are these founders projecting that, or are they projecting 40, 50, 60% EBITDA margins, which many of them are, which would suggest they're massively under budgeting marketing costs and staff and operational costs to achieve the level of revenue they think they can achieve. And therefore the founder loses credibility in their because they clearly don't understand what it's like to operate a business at the scale in which they're pitching. And then when it comes to the pitch, it is really about, again, that clear communication, and we use something called the 5-act structure to make sure we tell a brilliant narrative, which is the hook, the essence, the evidence, the plan, and the ask. And you could have a 5-slide deck covering those 5 things. You could have a 20-slide deck covering those 5 chapters, if you like, those 5 acts. But it's all about psychologically how are we building a message? How do we make a message that lands? And it goes back to the psychology of how humans evolved to and how we learn to absorb story and narrative. And then it's about clear and concise communication, making sure, little tweaks to your pitch, that instead of the headline being the problem, the solution, key milestones, make sure those headlines are the conclusion you want investors to come to on the slide. So it's MVP developed and ready to launch instead of key milestones, because we know that investors will do something called a flick test, and they'll open a pitch and they'll just flick through it. And if they like what they see, they'll go back and read it. Now, if every headline is just the problem, the solution, key milestones, they don't learn anything. But if they flick through it and it's just like top level conclusion is the headline, they go, this sounds great, I'll go back and read it in more detail. And it's those kind of little psychological tricks, really understanding the audience we're pitching to and the context in which they're viewing these documents, that enables us to get the sorts of results I talked about earlier. And then finally, probably the point on design is that same point. When you're designing a pitch, think about, worst case scenario, someone's viewing this on an iPhone in the back of a cab. So if your pitch doesn't cut, if you can't see it, if there's too much text and it's really difficult to view on an iPhone, then you're not going to get the engagement that you're hoping with the pitch. So you need to consider the audience and kind of think, worst case scenario, where are they viewing this? And probably the most likely scenario is in the back of the cab between meetings on a phone. So it needs to be so crystal clear in the way that it looks that the message comes through. So all of these sorts of things are the things we're looking at as we go through a typical project.
How much of what you do is just kind of getting the messaging out from the team that are looking for investment versus, actually making them think critically about their business and maybe actually going back to the drawing board and changing operationally some of the stuff?
I mean, 50-50, right? It's 50% of the time spent just kind of communicating what they tell us clearly. And 50% of the time we're spotting and identifying potential gaps and weaknesses. And when I say 50-50, that could apply to half of our clients have absolutely nailed it, and it is just a communication job for us. Others, they really have no idea. They've got an idea, they're really early stage, and they need real help and support. And we spot lots of gaps and weaknesses in their strategy. And then others, it's literally 50-50 for them. Like some stuff they're really strong at, other stuff they're weaker at. And we sort of jump in and give them strategic advice in the areas where we feel there's a gap. Now, sometimes there's a disagreement. We might look at it and say, we think you need this number of staff to typically an investor would expect to see a revenue per staff of X, and based on this plan, it's going to be 10 times that. Why is that the case? And if they've got a really good operational reason that is credible, that they can stand behind, then fine. But it's our job to highlight the things that could be a red flag to an investor and make sure that they've got a credible response to it. And if they do, and they're confident in their approach, it's our job to then make sure that's communicated in a way that that's no longer a red flag for investors. So every project's different, depending on the client and their stage of development, but we're always pushing back and kind of saying, have you considered this? This doesn't match with this, we don't think. Kind of tell me more about what you were thinking in this area, and we can help kind of unpick this and make it a bit more clear, obvious, consistent through the assets. So yeah, it's a bit of a hybrid approach on both. And if we just did one and not the other, we wouldn't have the success that we have. It has to, those two things have to go hand in hand.
For sure. At Robot Mascot, what does the team look like on a kind of new project?
So you've got a project manager who's a business strategist, really experienced business strategist that would take you through. So they get to know you and your business inside out. They go from start to finish on the project with you, and they're your main point of contact at Robot Mascot. So they have top level oversight of every step of the project. And then we've got a team of people internally that will be sort of business plan writers and strategists, financial strategists, ex-investors, copywriters, designers that produce all of the assets. Now, they're not customer facing, they're not trained to be customer facing, they don't want to be customer facing, but they're really good at what they do. So this business strategist is your main point of contact and make sure that the team are reflecting your business in the way you want it to be reflected, but also feeding back and sort of talking with you strategically about some of the gaps and red flags the team might uncover along the way, having those strategic discussions with you and forming a conclusion that can then be fed and briefed back into the team to deliver the work. So that's how we found the best way to work it is having that one person that sees you from start to finish and becomes kind of your guardian through the project, and is the person on your side within Robot Mascot. Their job is to be your ambassador, if you like, and fight your corner in the discussions.
And then on the kind of flip side, what does the process look like, maybe from a timeline perspective, for a client from the day they decide they want to work with you guys to level things up?
Yeah, I mean, there's no upper limit as to how long a project might take with us. It's a fixed price engagement, and there's no upper limit on time. It will take as long as it takes. As a general rule, we say, like, on average, a project's completed within 6 to 8 weeks. So 2 weeks on the business planning, 2 weeks on the financials, 2 weeks on the pitch, and then 2 weeks kind of left for any sort of buffer needed. Usually you can, if you sign up with us today, you'd be able to book in with us in 2 weeks or so time, sometimes 4 weeks, depending on how busy we are. We have limited capacity. But from the start date, after you sign up, it's 6 to 8 weeks, and there's an onboarding process that happens while you're waiting for your start date to come around in our schedule. So that's typically how it would work. We've had some that have taken longer. We just completed a project today, which my team just let me know. Someone who did a lot of pivoting, a lot of thinking, took a lot of time. Longest project to date, 702 days, 2 years pretty much. They went quiet for about 12 months while they figured some stuff out and then came back to us, which was, that's happened once in 10 years. But that's the longest. The shortest is about 5 weeks. So take your pick, anything from 5 weeks to 700 days, anything in there. But no, 6 to 8 weeks is a typical engagement.
And shifting gears slightly, I know when we spoke before, you said, investment isn't, everyone thinks it's about raising money. Really, it's about raising time. Can you just explain what you meant by that statement?
Yeah. So I say, when I'm talking about pitch for time and not money, because when you really think about it, an investor's most precious commodity is their time. They have wealth, plenty of wealth. They have the same number of hours in the day as you and I. And that time is very precious. They probably have 5 or 6 other business interests. Most angel investors are entrepreneurs themselves, or they're investment analysts at a family office or VC fund that are inundated with 10, 20, 50 pitch decks a day that they want to be going through. So time's their most precious commodity. And it's, it's not like TV. You're not walking into a meeting with with your pitch. They've never seen you before. There's wads of cash on the table and you're going to walk out with or without a deal. This is about, the pitch is about getting them to book into another meeting because they feel you're a credible option to invest their time in finding out more about. And eventually they might invest their capital into you if those subsequent meetings go well. So really, rather than going in thinking I need to get them to invest their money, I need to go in and get them to invest my time. And the reason I talk about that is because I think founders overload their pitch to answer every single question an investor might have in the hope that will lead to them giving them their money. When actually, if you can say less, and we've proven this by our pitch decks having such a higher engagement rate when we do 15 to 18 slides, no more than 50 to 100 words a slide. We keep it light, we keep it, we don't put too much detail in. If investors are asking you questions, the pitch has done its job. It's engaged them in what you have to offer, and they want to find out more, and they're drilling into the areas they care about, and you can then answer those questions. If you go away from that meeting thinking, oh crap, I should have added this, that, and the other to the pitch deck so I don't get that question anymore, you then start adding complexity to the deck and you reduce the overall engagement of it. And suddenly you're saying, well, I'm telling you everything you wanted and now I'm not getting any responses. So the trick is to remember you're always pitching for their time. If after your pitch they say nothing, you're getting no questions back, that's not a yes, I've answered every single one of their questions. That's a bad sign, right? They're not interested. They can't get you out of the door quick enough. So you really, it's an analogy really to try and help founders to think about the purpose of their pitch, and that it's to help them compete against 100 other pitch decks that the investors are seeing that week, to get a meeting so that they can explore in more detail in the business plan and the projections. And one of the reasons we create a business plan isn't because we think an investor is going to read it. Maybe 30% of investors will actually read it from cover to cover. They might dip in and out of it. The purpose of the business plan is more to give founders the confidence that if I'm asked that question, I've got an answer to it, and I don't have to put all of that in my pitch. And I feel more confident with a light touch, engaging pitch, because I know I've got all the detail sitting there in the business plan if I need it. And so as much as it's really useful to have in your data room and something that an investor is going to see, it's the process of developing that business plan that ultimately leads to a better pitch and a better answer to a question when you get the questions in the Q&A that follows that pitch. So that's kind of the reason we start there in our process.
I think that's a pretty powerful reframe, right? I've never heard this in the kind of investment or finance world before. You're almost looking at it like a funnel and a sales asset where you want to hook people in, pique their interest, and then they chase and want more.
That's it. I mean, we can't help ourselves because that's our background, right? Brand and marketing. So everything to us is a funnel, and that's the unique edge that Robot Mascot has, and why we get the results we have is because we've framed investment in that way. It's no longer just a pitch deck about business opportunity. It's a sales funnel where you're looking to engage an audience, knowing that a number of them will drop out through the process until you end up with the people that close at the end. It is a sales funnel. That's all this is. If there's one takeaway from your audience, it's raising investment is just a B2B sales and marketing campaign. Your product shares, the audience are investors, and however you approach sales and marketing for your current product, you can apply probably those same strategies to running an investment campaign.
Does that message resonate the first time you speak to potential clients, or do you need to kind of break it down more for them?
I think it resonates. I think it does. It appears to. I think people get it. It's quite an eye opener for people, I think, when they first hear about it, and when we sort of go into a bit more detail as to around the communication angle as well, and around sort of investors really care about risk assets proof implementation. That's the stuff that they want to hear about. But founders are pitching about ideas and opportunities and possibilities, and it's like you're pitching the wrong stuff, right? You're saying the wrong things to an audience, and you're not treating it like how do I hook them in? How do I get their engagement so I can then spend some time with them? So yeah, I think once I do a weekly workshop where I talk through this stuff, and I think once people have left that sort of 90-minute session, they're just like, yeah, I can see how that makes sense and why that would work. I think I'd like to think that that's what happens. Evidence would suggest it does, given that the clients we work with and the results of the way we've reframed it from our own personal perspective as a business. So yeah.
Okay, I want to touch now on your book, so Investable Entrepreneur. Can you just talk through why you created it in the first place, and then, what's included? What are you talking about?
Yeah. So I think there was two reasons I wrote it. One, as we kind of said earlier, we were pivoting, and I was learning lots about how to pitch, what investors were looking for. We were applying this to projects and learning sort of on the go and getting more and more expert in this space as we pivoted the business. And my brain was exploding with all of this stuff. And I kind of knew from people that I knew who'd also written books, business books, that one way of kind of structuring that stuff in your head about all that knowledge you have and explaining it in a way that you can better communicate with your potential audience is to write a book. And that helps you kind of frame that thinking in terms of structure and methodologies and processes, because you're writing a helpful guide. So that was one reason, was just to help me mentally kind of organize all of this stuff we'd learn. And the other thing was just because through this process of talking to all these founders that I was getting so many questions that were the same question again and again and again. And I just kind of thought there clearly isn't a resource out there that these founders are finding useful enough to answer those questions. So I wanted to make sure the book kind of touched on all of the things that I got commonly asked. It became like a big FAQ as well. So it goes really from kind of preparation, things you should do before you even think about pitching for investment, around traction, validation, the mind of an investor, all of the stuff you should know before you even start the process of preparing for funding. Then the second part of the book is our process we take clients through. The methodology is called the 6 principles of the perfect pitch: plan, projections, content clarity, structure, content clarity, design. So you've got these six pillars you need to go through to create a clear and articulate pitch. And then the final section is, now you've got all this stuff in place, what do you do with it, right? You've got a pitch. How do I go and find some investors? How do I run a management and manage a campaign? Who should I pitch to? Who are the different types of investors and which ones are the right fit for me? So then it's kind of like making it happen. How can we, and again, it uses the business to business kind of marketing campaign as an analogy of how you might run a campaign, and just liken the process to a typical B2B sales cycle. So yeah, it's in those 3 parts really: preparing, getting ready, and then the execution of a campaign.
Do you often have businesses that will go through that preparation phase and maybe, actually realize we're not ready to raise, or we shouldn't be raising? And if so, what are the kind of common reasons for that?
Yeah. So not clients that we're working with, because we have a robust process where they fill in some online assessments to then go through to the strategy sessions that we run. And then they often self-select as to, I'm clearly not ready yet. And then if they do go through that session and go, yeah, I feel I'm ready, I want to work with Robot Mascot, and we have a one-to-one call, we have an interview, another secondary assessment, which goes a bit deeper, and then it's sort of a one-to-one call. That's as much me interviewing them as them interviewing us, and seeing whether there's a fit of working together. So it's very unlikely that people end up working with us in a position where they can't raise. There may need to be a discussion as to how much they raise and what their strategy is given where they're at, and they might be looking for too much funding for their stage of development, and we might have to have a discussion around that. But it wouldn't be a case of you can't raise anything, it's far too early. So that's quite unlikely that would happen. But there are, of course, lots of people that we turn away, where they really want to work with us, and it's like, come back in 6 months and go and achieve these things first, because there's two core things we can't affect. One is the team. do you have the right team around you, whether that be co-founders or whether that be, if you're a sole founder, it doesn't mean co-founders, it means advisors that might be around you, or founding team. So do you have people around you that investors could look at and go, they're not on their own, they've got other people around them, and they can all, these people all hold the keys to potential success with their experience. And the second thing we can't affect is product market fit, traction, validation, kind of having some level of research, and what the level that is depends on where you're at in your journey, and what sector you're in, and what you're trying to raise, and what for. But based on what you tell us about where you are in your journey, we'll make a judgment on whether or not you have enough progress to date to make this a viable opportunity, or whether you need to go away and work on some stuff before we work together.
Okay. I want to zoom out now and just look at kind of a few macro points around, kind of potential investment, or, which path to take. Not every business obviously needs investment. How would you advise a founder to go about thinking through and deciding whether they should kind of bootstrap or seek external financing?
Yeah. So I think there has to be an ambition for venture scale returns, right? So what does that mean? If you're going to pitch to an angel investor, whether you're an SME or a startup business, and you're going to look for some working capital to move your business forward, depending on your sector, as a minimum, investors would be looking for a 5 to 10x return. If you're in a sort of high scale kind of tech industry, you're probably looking at 30x return on their investment. So if you don't have a plan, or you don't believe that in 5 years or so, if you spend their investment, it's going to catapult you to a point where your valuation is 5 or 10x in 5 years, then maybe you're not the right fit for an investor. That being said, there's plenty of investors out there that aren't doing this for capital sort of growth in the valuation of the equity in a 5-year period. They're happy to wait a longer time frame for that, or they're interested more in dividends. And if you're in a profitable position where they can start to get a payment back on their returns through dividends, they might be interested. There's less investors, to be honest, that are in that camp. Most of them are looking for, how can this capital asset, this value of this company, this equity, go up in value by 5, 10, maybe even 30x. If you're pitching to venture capital funds, your later stage, you're pitching for your Series A round to VC funds, don't be surprised if that figures 50, 100, 150x return on investment. They're the unicorn hunters. So unless, if it's just some working capital to buy some equipment, you probably want to get a loan. If it's working capital to accelerate growth, and you're hell bent on delivering 5, 10, 20x growth in 5 years, and this is moving you from kind of a lifestyle business to a performance business, then maybe you're in the right space for equity investment. But yeah, if investors don't see they can get the returns, they might as well stick their money in property or the stock market. So you have to, given the risk involved in investing in a small business or a startup business, you have to make the returns worthwhile. Otherwise, what's the point?
Okay. You mentioned it there, the kind of lifestyle business versus performance business. I know it seems to be a bit of a trending question at the minute. Can you just break down the differences between both of those types of business, and why it's crucial for founders to kind of pick one path?
Yeah, I think you need to know what you're comfortable with, and that might change over your entrepreneurial career. But a lifestyle business is as it sort of sounds, right? It pays you a good life. You take out of the business as much as you can to enjoy with your family or your friends, or spend on yourself, and you draw as much as you can out of the business. And maybe there's a team of up to about 8 people. Beyond that, you start getting too big, but you're probably up to about 8 people in terms of a team. And you're highly profitable. You're well known for what you do. You're kind of an expert, but you've got this nice little niche, and it pays you a really nice salary. You then have performance businesses, which are sort of 50 plus staff, highly valuable assets within the business in terms of IP, in terms of systems, in terms of processes. They're the ones that are going to be able to be sold and acquired. Your lifestyle business, you're probably going to just sort of put as much money into your pension as possible and wind the thing down at the end. If you're lucky, you might be able to sell it for 0.5 times the revenues it generates every year, or something like that. with a performance business, you're looking to sell it for 2, 3, 4, 5 times its revenues to deliver you and your shareholders. You've got a board structure, you've got 50 employees, and there's a gap, right, between performance at 50 employees and all of these valuable assets and this huge valuation and kind of a lifestyle business that's paying you a wage. Now, this is from a chap called Daniel Priestley. You may have read his books, you might have seen him on some podcasts. Really great guy, but he talks about there being a gap between lifestyle and performance, and I believe he calls it the desert. And you have to cross that desert where you're too big to be small, you're too small to be big, you're really profitable. Then as soon as you hire your 10th, 11th, 12th staff member, suddenly you become really unprofitable. You've got too many people, you need a management structure, but you're sort of too small to have a management structure, and it becomes really difficult. So the job is to try and accelerate quickly from lifestyle to performance if you are on that journey. And that's where funding comes in, because when you get the funding, you can hire the people quickly, you can set up those systems and processes so you can accelerate quickly to performance. So that's where it's used in most cases. You're a startup trying to accelerate to performance, or you're a lifestyle business now in a position where maybe you've spent the last 10 years in your business, your kids are now grown up, they're leaving home, and you're like, we now want to take an advantage of some of these opportunities coming our way, and I'm in a time in my life where I can devote more time to this business and really push for that performance as I head towards retirement, perhaps, and build something for retirement. And that's where you might seek funding to push through that desert, as Daniel would call it. So that's kind of the difference, and you've got to stick in a lane. If you want to be somewhere between the two, you're probably going to be quite unprofitable, and you're going to find it really difficult. You need to sort of pick a lane and stick to it. And it doesn't mean one can't transform into the other. Quite hard for a performance business to go back to being lifestyle. But if you're a lifestyle business, you can bide your time. You don't have to do it right now, but you can say, I'm building lifestyle right now, but I need to see that path to performance, that path to millions in revenues, and I need to be able to back that up with strategy, and I'll raise some investment to make that happen.
So I was talking to a friend of mine this morning about this, actually, and he was saying, if a business isn't growing, it's essentially dying. And his view was that the lifestyle type business isn't worth it because it will kind of naturally degrade over time. Do you think that's a kind of correct point of view?
I don't think so. Maybe. I guess. Yeah, you've got to be continually growing, but you can grow revenues without and profitability without necessarily having to grow everything else. So the sorts of things that lifestyle businesses might do to continue that growth curve would be to look at how they can increase their average order value by bundling more stuff into bigger packages and going after a different client set with bigger budgets. Still the same team to deliver it, but higher profit, higher margin services. Parallel products, looking at ways you can utilize the same team and the same structures to sell those into a different audience set by repositioning what you do. So I'll give you a good example of that. At Robot Mascot, we do investment pitches for SMEs and startups looking for the pre-seed and Series A funding. As a result of that, we started getting some VC funds saying, well, could you not help us with our pitch? Absolutely, yeah, why not? And now we're launching services specifically for VC funds. Now, it's exactly the same methodology, exactly the same team. Everything's exactly the same, apart from we're now repositioning what we do under with a different package to a different audience, and that's going to increase our ability to grow. So I don't think it's necessarily true. I think there is a limit, right? There's a limit at which, but just because you're capped at 8 people, X million a year, Y profits, that you're drawing a dividend, it doesn't mean you're dying. You might happily be stagnant, right? And that pays you as long as you're always innovating. I think that maybe what he's telling is there's a tendency in that position to now go, I've built everything, I've got my systems, I've got my processes, it will just carry on and be like this passive income for the next 10 years. That is completely false. To maintain as a lifestyle business, you're going to have to continually innovate and improve your products and understand your market, look at in market fluctuations, see if you can do things to keep that revenue where it is. But it's okay, I think, to strategically say, but I don't want to grow any more until I've got a line of sight to kind of massive growing up to sort of 50 employees, because I know I'm going to be in this tricky period where I'm too big to be small, too small to be big, and my profit margins are going to be squeezed by the additional staff I need to hire to manage just a small amount of extra revenues. I think that's perfectly okay for a business owner to sit there and sit on that for a few years, as long as they don't just think it's going to continue without doing anything. You still need to be innovative. You still need to push the business forward just to maintain.
Yeah, I think that's a very important clarification. Now, I know you've kind of helped businesses raise from, anywhere from 150K to tens of millions. At what stage should a business start considering investment, and what do they need to have, things in place before approaching investors?
At an early stage, you're looking for that kind of few grand, few 100K to get things going, to build the first version of the product or whatever it may be, do some beta testing. You're going to need a certain level of validation around your market and your idea, a certain understanding of how your next steps are formed to unlock your next round of funding. So you always should be looking at this round and the next round, and you should be saying, what do I need to raise this round? Well, at an early stage, that's probably some market validation, some surveys, focus groups, evidence of initial kind of product market fit, founder market fit as well, sort of or a team of people that align with the market, that are around you, evidence that you have something interesting that the market wants and needs. If you've got that through surveys, focus groups, some initial kind of proof of concept, maybe some mock-ups of your product that people have looked at and said, yeah, I would need that, then you're probably in a position to go and raise that pre-seed funding to go and build the first prototype or the market ready MVP. And then you can go raise funding again for your next round. So I say you should be looking at this round and the next round, because when you're pitching this next round, this first round, you need to be thinking, well, what are the key milestones I need to achieve to unlock my next round of funding? So if you're going to then go and raise your seed round, you know that what you need to spend your money on is beta testing that proof of concept, developing it further into a market ready MVP, and maybe launching this with your first kind of live users. Just a handful of them, not huge amounts of revenues, but people are paying you to use this very early version of the product. And then you can go and raise your seed round. And then you might go, well, what do I need for my Series A? Well, normally that's getting to kind of 80K a month recurring revenue, $1 million a year in annual recurring revenue, and then you unlock your Series A. So you kind of need to understand these milestones that investors are expecting for each stage of the journey, each round of funding, so you can work your growth strategy into, I would love to go and build the brand and create the marketing and all of this stuff, but actually what I really need to focus on is surveys, focus groups, and these sorts of things to go and my time and effort should be on that, not developing this amazing brand, because investors don't care for that right now. That comes in 18 months time when we launch the thing. Right now we just need to prove these key points. So always thinking about that, I think is and it depends on so much on your sector and stage of development and what you're aiming to achieve and what progress you have to date. But that's a general rule, but it's quite hard to pin it down to one thing.
Okay. Can we talk now about giving up equity and control, and just maybe touch on, how founders should think about dilution and structuring deals to ensure they still kind of have, overall ownership so their vision can come true?
Yeah, it's an interesting one, isn't it? Because as a founder, you want to keep hold of your baby, and you don't want to let anyone else have too much ownership. And the biggest fear is giving away too much control. So there's two things to think about from this perspective. Firstly, there is no point owning 100% of nothing. If you have an idea, it's completely worthless without execution. If you need capital to execute it, then you're going, I'd much rather own 55% of 10 billion than I would 100% of nothing, right? So if you'll go on a journey to a performance business that's going to be worth hundreds of millions or billions of dollars, much better having a smaller stake in something huge than 100% of nothing. So that's one way to think about it. The other way to think about it is that you're not giving away equity, you're selling it. This is an exchange of something of value, your equity, in return for something of equal or greater value, the investor's capital. Just like any sales and marketing process, just like any product we buy, you don't go into a shop and pay for something you believe is worth less than what you're willing to pay for it. an exchange in marketing is something of equal and greater value. I will go and buy a TV in Currys if I think the TV I'm getting is of equal or greater value than the price they're charging. If I think it's a rip-off, I'm not going to buy it. So when you position your pitch to investors, you need to think about how much equity you're selling and whether that's equal or greater value. You know, is 30% of my business or 20% of my business or 15% of my business worth the amount that I'm asking investors to invest in my business? And that comes down to understanding your valuation, but it's selling your equity for something of equal and greater value, not giving it away. And the final thing to think about is, what's your fundraising journey? So I've seen so many founders fall short of this, and it's really screwed them up on their journey. So they think they've negotiated themselves an incredible deal at pre-seed, and they've been able to raise 250k for 6% equity. And now they're going to their seed round and they're worth however many millions. And the investors in that seed round are going, no, you're not. There's no way you can be valued at that. And they go, no, we are, because we sold this much for 6% in our last round, and then we've gone and built all this stuff, so we must be worth more than we were worth in our last round. And just for argument's sake, our last round we were valued at 10 million and we're now pitching at 12.5 because we've gone up in value in the last 18 months with all the work we've done. And they go, yeah, but you weren't valued 10 million then, and you're not valued 10 million now. You're worth 6 at best. So now you're a founder in a position where you thought you got yourself a great deal, and you're having to ordering to close your next round. You have to do a down round. You have to reduce your valuation and turn to your existing investors and say, really sorry, guys, I screwed you over in that first round. You got a crap deal. You ended up investing in something for half the equity you should have received. And that's a really difficult position for a founder to be in. So sometimes it can feel like you're doing the right thing by holding on to as much equity as possible. And that's great if you're only ever going to do one round of funding. But if you've got a second or third round that's needed, you could actually be shooting yourself in the foot by not being generous enough. So the way I like to think about it is this should be a relationship between you and your investors. Your investors are funding your ambition. They're funding your growth. They're part of your journey. And you should be rewarding them for backing you when you're most volatile. You know, you're the most high risk you are. You know, in your first or second round of funding is the most high risk time to invest in a business. So you're rewarding that faith in you and your vision by offering them a decent share of the company. Now, if we want to talk numbers, a typical pre-seed or seed round would be somewhere between 15 and 25% in my experience. So if you're going for funding, you need to be comfortable with selling 15 to 25% of your company in a pre-seed or a seed round, because otherwise you're not being generous enough with your equity. You're not going to bring the right people into the business. You're probably going to overvalue yourself now, which will make raising your next round more difficult. So you need to get that balance right between trying to hold on to as much of your own equity as possible and not being over diluted, because you don't want to be in a position after 3 or 4 rounds where you own 30% of the company and you're kind of thinking, is this really worth it? But equally, you want to get that capital on board under a sensible deal so that you can leverage all the opportunities that come your way. So it's a really tricky balancing act, and I get the kind of yin and yang that founders feel on this, but you need to be honest and go, can I make this happen without selling equity, and how much do I want to reward investors for that faith in backing me in my vision? Let's say 15 to 25% is the typical figure you would expect to need to sell to raise those first rounds of funding.
Okay. And at those kind of early stages when there's not that much data available, how are you coming up with these kind of numbers of, for sure you talked about, what percentages people should be giving up, but how to value the shares?
So, I mean, it's pretty difficult. There's it's an art as much as it is a science, and everyone will have their own opinion. The way we do it is we use 5 different valuation methods for our clients. So 2 of them are qualitative approaches. They're called scorecard and checklist. And they basically look at industry averages. One of them uses an average valuation for businesses of your stage of development in your sector. The other uses a maximum valuation, a maximum achievable valuation. But essentially they do the same thing. They split the business opportunity across different things like the intellectual property, how difficult it is to recreate, and therefore potentially the value it is. The more difficult it is to recreate, the more valuable it technically would be. How much funding is required to achieve the vision, the strength of the team, the size of the market opportunity, all of these sorts of things, and it scores them. So let's take team, for example. Let's imagine we had on one end of the scale, we had a student straight out of university with no life experience, let alone business experience. And on the other end, you had a co-founding team of Elon Musk, Jeff Bezos, and Richard Branson. And let's just pretend for a moment they would all get on really well if they started a business together. So you're on that scale. You're somewhere on that scale as a founder, as a founding team. And what we would do is judge where you are on that scale. And depending on where you score, depends on whether you're above or below average. And then that, using big data, you can calculate your current valuation. You then use two methods called discounted cash flow, and we do one with long-term growth and one with multiples. But essentially, they are saying based on the free cash flows of the business and your projections, and providing we agree that your projections are ambitious yet realistic, we can agree that the future cash flows of the company could be X, and if we therefore the valuation would be Y, and if we discount it back to today's value using various different risk factors, here's what your valuation would be today. Now, those tend to provide a much higher valuation because the growth, the hockey stick growth that most startups project, means that they end up with a really high valuation with those, and the scorecard tends to be much lower. And then we do a fifth valuation that basically says, what does an investor want? From an investor's perspective, if I believe your forecasts to be possible, here's what your valuation could be at exit, and therefore here's how much my shares would be worth. If I want to get a 30x return on my investment, I have to invest you at this price today to be able to achieve that 30x return in the future. Otherwise, it makes no sense for me. So we have these 5 different conclusions and 5 different valuations for your company, ranging from small to large. And then we can do like a weighted average and say, well, we're really early stage, so we're much more suited to the scorecard and checklist approach, or we're later stage, we've already got 3 years worth, 5 years worth of revenues, so our discounted cash flow is much more reliable, so we can use more of that in the average. And we do this weighted average between the 5 to conclude the valuation. Now, that might sound really complicated and over-engineered, but the idea of it is to say, look, we understand that we could pick this valuation method and you could pick that one, and we could end up miles apart. We understand that this is an art as much of a science. So we've done the work and we've looked, we could be from anything from X to Y, and we think Z is a fair middle ground to start negotiations. And that normally means you're in a really solid and strong position to discuss. And you're going to have to drop, no one walks away with what they want in a negotiation. But you're going to have to meet in the middle somewhere. And the idea is that you're in a negotiable tolerance. You're within a place where investors go, well, you're a bit high, but we can probably find some middle ground. You're not so high that it's not even worth getting into a discussion with you about it. So that's the trick, is to kind of get it into that negotiable tolerance, but back that up with, we understand how this could be valued in multiple different ways, and we're not naive to that fact, and we're open to negotiation on this.
Makes complete sense. I want to flip this on its head now and talk about, from a founder's perspective, how do they evaluate different investors and what should they be looking at? And I guess, as well as that, are there things kind of, I guess, softer benefits of, a certain investor, maybe access to a network, input from an advisory perspective on the business or something like that?
Yeah, a really important one. I'm glad you brought it up because I don't think too many founders think about this. We have a checklist of things that founders should do to do due diligence on their investors. I'll try and remember some of the points on that we shared with our clients. The main thing would be, what else do they bring to the table other than money? If you want them to bring other things to the table other than money, but most early stage founders would want a fairly active investor that can add insights and open doors, and what can they bring to the table? Do they want an advisory position? Are they able to open doors? Are they experts in something where you have a gap and they can really help you bring in the right team members to fill that gap? What resources do they bring beyond capital? You then want to find out what their investment style is like. Are they passive? Are they active? How often do they want to meet with you? This often comes down to how much money they have. So you'll find that investors that maybe only have a limited amount of funds, let's say 200K a year to invest, and they're making 4 investments of 50K, they're probably more likely to want to know what's going on every month with the business to see what their investments are up to, than because they're, it's a big deal for them. They have, that 200K is a lot of their personal wealth that they've put into this. Whereas a family office or an investor that's got millions to invest and they're doing 20 or 30 deals a year, they don't have time to be so focused on them all, and it's all about spreading the risk across a larger portfolio. So you can get a sense of how active they might be. We would also recommend you ask them for references. Who else have they invested in, and what can I speak to those founders? If they're a good investor, they'll let you speak to their portfolio. If they're a shit investor, they won't. And then when you speak to those founders, or you go and find them online and you connect with them, you find out what they're really like. And we have had a client dodge a bullet where they contacted a founder on LinkedIn that their investor had invested in, and they said, don't do it. He's an absolute pain in the neck. Worst decision we ever made. He takes up so much of our time. And they dodged a massive bullet. So yeah, those are the sorts of things. We've got a list of kind of questions you would do to interview the investor, and that makes you more attractive as an investment opportunity as well. Rather than them just throwing a load of questions at you and scrutinizing you about your business, you can sort of flip the table and go, so tell me a little bit more about your investment style, and then reel off 5-10 questions you want them to answer to see whether or not they're the right fit for you. And suddenly they go, oh, hang on, here's a founder who knows what they're doing, and I like that. I like that they care about who they bring into the business, and they want to know these things about me, or at least the right investor would appreciate that. The wrong investor probably not so much, but it helps you filter them out. So yeah, absolutely do your own due diligence on whoever you bring into the company. Same with any advisors that you might bring in for equity. You want to make sure that you do your due diligence on them. You want to make sure you have vested shares. So if they do go AWOL, if they do not deliver what they promised, you can take those shares back. They haven't got them forever, regardless of whether or not they deliver. So those sorts of things you want to make sure you have in place whenever you're dealing with equity and bringing people into your company.
Okay, but just to clarify, especially at the early stage, you are expecting kind of non-financial input from investors, whether that be, help on hiring, advice, lead flow, maybe if you're an agency.
I would expect that in 95% of cases that the investors are going to want to give some kind of inputs. Even VC funds are going to, at that stage, at early stage, are going to have accelerators and incubators and academies to support you. So most investors will want to coach and guide you to make sure that their investment delivers. But there are passive investors out there at an early stage that will just give you some money and you won't hear from them again for years. And some founders want that. Most of the founders we work with don't want that. They want someone who's going to affect the business and open doors and do stuff. So, but that being said, let's say you're doing a round and you end up with 10 investors as part of your round. And they're all kind of small ticket investors as opposed to 1 or 2 large ticket investors. Now you're in a position where actually you probably don't want 10 cooks in the kitchen. You probably only want 1 or 2 of them to be kind of active with board seats. And then you start saying, well, who gets a board seat? Who doesn't get a board seat? Who's just giving money? Who's giving input and advice? How do we report to these 10 investors? Do we have a quarterly meeting and everyone agrees that in the heads of terms? And therefore, if people start messaging you weekly, you're well within your rights to say, wait for the quarterly meeting. That's what we've agreed. So it's just about managing expectations in that scenario. And you can't have too many active investors because you'll never have time to actually do anything by the time you've had 10 meetings a week with 10 highly active investors all pulling you in different directions. So you got to manage it in the right way.
Okay. You've touched on this kind of a few times throughout this chat of, different types or different parts of the ecosystem. Can you just talk through at a super high level, what are the typical different types of investors that you see?
Yeah. So traditionally you've got angel investors, VCs, and family offices as the three key characters that invest in a startup. We more recently we've started to split angel investors into 2 categories. One is angel investors and the other is high net worth individuals. Now they're technically the same thing. They're an individual that will invest in a company, but the reason we've tried to sort of give them a different criteria, different kind of character set is because they think differently. Like people on You've got the traditional angel investor, was someone who was like a business insider that had built their career, got some wealth, and wanted to invest in the next generation of ideas and businesses coming through. What seems to have happened is angel investing has become much more professionalized, with the angel groups and all of the support and advice that's out there, and people have angel investor as their job title on LinkedIn. Now, I would say that anyone with angel investor with their job title on LinkedIn is a professional angel investor, and therefore they're actually a one-man band VC fund. They're a sole trading VC fund. They think like a VC fund, they act like a VC fund, they're looking at metrics and ratios, and they're assessing deals in the same way as an investment analyst in a VC fund. They're not your kind of classic angel investor that's a bit more shoot from the hip. I'm an entrepreneur myself. I can help you. I can support you. I can guide you. I just want to be part of this cool journey. And if we make money, great. If not, this is going to be, I'm here for the ride. We kind of determine those as sort of high net worth individuals, business leaders, with wealth to invest. So I'd split those down and therefore say you've got your high net worth individuals, your business leaders and owners that will come on. Maybe they have invested before, maybe they haven't, maybe you have no idea because they're not publicly shouting about it. And they're kind of experts in your industry and they can open a load of doors. So that's your first kind of target. Then you have angel investors, which are your professional angels, your sole trading VC funds. Then you've got your venture capital funds, which are much more sophisticated. They have a team of investment analysts that are looking at all sorts of information around the deal. They probably they probably run an accelerator or academy program to support you and guide you and mentor you, maybe provide some support and advice around particular topic clusters. And they do all of this so that they can turn to their investors. It's not their money they're investing other people's money, like pension funds. They call them limited partners. They can turn around to their investors, their limited partners, and say, look at all the things we do to make sure your money works in this investment structure, and therefore you should invest in us and not the other VC fund down the road. So they do all of this stuff more for their own benefit to raise their funds than it is for your benefit as a founder, although they obviously want to get the returns from that because they need to promise that they need to deliver on their promises to their investors. And then you've got the family offices, which are the professional investment analysts that are managing the wealth of ultra high net worth individuals. So again, although the owner of the money might be that high net worth individual business owner type, they're less actively involved because their money is managed through a team of investment analysts and a family office structure. So it's the personal wealth of an individual, but managed like a VC fund, but probably slightly different in the way that they behave and act. But they're your four kind of characters. And when you're at an early stage, it's really high net worth individuals, angels, maybe some early stage funds. But when you're sort of seed and series A, you're probably looking more at professional angels, VC funds, family offices. But at the very earliest stages, you're probably looking at the high net worths, the business owners and leaders that want to be part of the journey, and they sort of come on board in an advisory capacity. They're the people that are most likely to want to invest in you at a very, very early concept stage.
You touched on advisors a second ago and said maybe that could be a good option pre-funding. How do you kind of think business owners should go about thinking about whether they need an advisor and what that advisor could bring to the table?
Yeah, so I think if you're raising funding and you're aiming for this performance-based business, you can only do it with a great team of advisors around you. I think I've got an article on this. I'll try and remember the information in it, but essentially there's four types of advisors you need. One would be one with sort of technical expertise in the product that you're developing, or the business model that you're running. Another would be entrepreneurial expertise. They've built and scaled a business. Maybe they've exited it, but they've got entrepreneurial experience in building and scaling businesses. So it's all well and good going and getting kind of someone from KPMG on your board as an advisor. They're great when they've got £1 million budget to spend or a £10 million budget to spend. They're not very good when you have to bootstrap yourself to success or spend a few £100K to get your first few clients. So someone with real entrepreneur experience. Marketing would be the other area, making sure you've got someone with experience in marketing, but again, having been a team member at an early stage startup or having run a startup themselves, someone who really knows your audience, knows what it's like to get your first up to your first million, or from your first million to your first 10 million, whatever stage of development you're at, relevant to where you are. Again, the CMO of KPMG or the CMO of some big multinational may sound good as a CV, but they're going to be no good without a £10 million budget to spend on sales and marketing. So they're the sort of three main categories: entrepreneurship, product expertise. Entrepreneurship, product expertise, business model expertise, and marketing expertise. If you've got the right people, the right experience for your stage of development in your team in that area, that would be the holy grail of advisors. And then the final point I'd make is if you're raising your second round of funding, what tends to happen is you've built a load of product experts to build your MVP, and then you go and raise your next round of funding saying, we're now launching to market, and you forget to update your board or your advisory team with people with expertise in sales and marketing. So investors are looking at this going, right, you're going to take my money and you're going to launch this to market. And that's going to happen how with a team of 4 product experts around you? No one's got any experience of doing this. You've all built something awesome, but no one's got any experience in sales and marketing. So at each stage, you have to think, what am I pitching for? And what advisory team do I need around me to execute on that stage of my journey? So I'd think about it in those terms as well.
Okay. And you mentioned there, I think what I'm reading is that sometimes these advisors might be for a temporary period, a short-term kind of timeline. How are you paying these guys? Is it with equity, and do you take that back if you kind of upgrade your advisory team? How does that work?
So some of it might be sweat equity. Other times you might pay them. It depends what position you're in. You might pay them as an non-executive director on the board, for example, or you might just pay them as consulting fee for some mentoring services. But often it's equity, it's sweat equity, and you would vest that over a period of time. So let's say, just to make the math simple, let's say you bring on an advisor and you think they're going to be good at providing advice to your business over the next 3 years. So then you offer them 3% equity for their advice and support over the next 3 years. And as part of that deal, you expect them to give, I don't know, 1 hour a month for the next 3 years. All of their experience, their contacts, you have heads of terms as to what they're going to agree. Now you vest those shares, and you can use tools like Vested or Seed Legals to help you vest these shares. But essentially what that means is they earn that equity over time. You don't just write them a share certificate and say, you own 3% of my company now, and they go, thank you very much. And oh, by the way, I'm not going to give you any advice, and they just disappear. And then you become a multi-billion-dollar company and they trade that in and happy days. You vest it over time. So you would say that they earn 1% a year for the next 3 years, and beyond that, they just keep their ownership. They might continue to be useful to you, but if they're not, it doesn't matter. They've earned their shares. They've got you to that position in 3 years' time, and they're well worth the 3% that you've given them, because you wouldn't have been able to get there without them. If they don't give you the hour a month that they promised, or whatever the arrangement is, they go down as a bad leaver, and essentially you claw back everything that they've got. So let's say you're 2 years in and they've got 2% of equity, and then they go AWOL. You can say, well, they're a bad leaver, so I get all of that equity back. They get nothing. You get it all back. So if they want to get their 3%, they have to follow through, unless there's some mutual agreement that says, look, we've actually grown quicker than we thought. You've achieved everything we wanted to achieve. It's not about time, it's about output, and we're going to re-engineer the deal. You're still going to get your 3%, even if you don't give any advice for the next 12 months, because you've served your purpose and we mutually agree that that's the case. But in principle, it allows you to pull back those shares if they go AWOL, or if they don't deliver on what they said they would deliver. So always vest the shares, essentially, is the moral of the story.
Okay. I want to kind of talk about the investor expectations and what happens after completing that initial stage of the funder journey. Once the acquisition or investment process is complete and the founder has investment, what should they expect, and what does investors typically want them to do next?
Once the money's deposited in the account and the shares have been exchanged, if we're in that position, then you need to now execute on the plan, right? You need to go and deliver what you said you would deliver for the funding that you've achieved. And again, this comes down to what's agreed in the heads of terms, but essentially you would be going away, executing on that, and reporting to investors on progress. And my advice would be to report regularly, ideally monthly, maybe with a big quarterly presentation, but just a report on kind of this is what we said we'd achieve this month. This is what we have achieved. This is what we haven't, and here's why. Here's went wrong. Here's what went really well. Here's what went wrong and why, and what we've learned from it. And here's what we need right now. So if anyone's got connections with someone at company X, we'd love to speak to someone there for this reason. So you're always leveraging your investors and reminding them to support you along the way. So, but really it's about executing. You got to execute it and starting to prepare for your next round of funding. So if you know that you're going to run out of capital in 18 months time, and that's your runway for the investment, you want to, 6 to 9 months into this, you want to start preparing your next round. You want to start making sure that you're building the relationships with investors, you're preparing your pitch materials, you're getting yourself ready for the next round of funding so you can do all the legal and the due diligence and have that money in the bank. So there's no kind of down tools while we raise our next round of funding. So you're going to have to kind of try to juggle those two things of executing and preparing for your next round of funding. But yeah, depending on your agreement with investors will depend on how much you need to report to them, how much input they might expect. But yeah, it will be all hands on deck and making stuff happen.
Is there anything, like obviously you've worked with, hundreds, if not thousands of investors. Is there anything outside of kind of financial returns that they like to see or that excites them about deals?
Yeah, I mean, we risk homogenizing all investors into one hive mind, and they all think the same. So they've all got their things that they love. Some will love certain types of businesses because they love that kind of sales and marketing strategy, and they love to get hands on, and they love to kind of be part of it. But you've obviously got your impact investors, and there's always those that prefer to invest in something that's going to deliver an impact and social or environmental impact in lieu of returns. So they might be willing to reduce their potential returns in return for high impact. So there's those types of investors. You've then got the investors that are would be, they still want the high financial returns, but if you have an impact story that they can tell around the dinner table to make themselves feel good about themselves, then that might give you a bit of an edge versus somebody else. You've then got the investors that just want the cool thing that they want to be able to talk about at the private members club, and they're doing it for no more than sort of boasting rights. And then you've got the more strategic investors that are looking for real, insights into a really credible market opportunity, and it's all about managing a portfolio of wealth, and they've done all the calculations around a portfolio of 10 clients and what equity they need to have and what the success rate might be in terms of successes and failures and how they can deliver a return, and it's managed like a fund. So in my book I talk about sort of 10 different angel investors and sort of their different personality traits, but there's all sorts of things that they look for. The majority of the time it's financial returns. There's no point in doing this. Two things: one, financial returns, and can I add value to this? Many of them, many angel investors and these high net worth characters, they are looking for, they've had success, right? They're doing really well with their own businesses. They're at the point in their career they want to start giving back, and they've got so much knowledge to share. And they want to be able to have an impact on the next generation come through, and they get their kicks from being part of that journey. They don't want to have to do all the legwork anymore because they've been there and done that, but they want to be, they miss that exciting entrepreneurial spirit, the building, the developing, the learning and pivoting. And they're almost buying a seat at the table, saying, well, you do all the work, but I get to sort of come along for the ride, sit in the passenger seat and kind of be part of that race. And that really excites me. So I think, it's fair to say that probably most angel investors find themselves in that category. They're doing it for the ride. They want to be part of that journey. And if they get a return, great. They have to think about this. But yeah, it's about being along for the ride and being with an awesome team of people that they get really excited about. And they want to be part of that journey.
Sure. Okay. Most of our audience is in the e-commerce space. What would you say, from what you've seen, are attractive characteristics that investors are looking for in e-com brands that they're investing in?
I mean, as with any business, it's the high growth, the high returns. Is it drop shipping other products? Are you creating some valuable IP that you're selling via an e-commerce channel? Is there some unique, are you setting up a new type of e-commerce platform, a new way of trading through e-commerce, and you've got some real exciting IP that's going to compete with current e-commerce platforms. So I think, if you can position this as not just ways to scale revenues, but actually there's some valuable IP behind this. An IP can mean the product itself. It could mean the systems and processes that you use, and a system and formula that you have. But if you can position this in a way that shows huge prospective, potential revenues, a clear market opportunity and market gap which you're taking advantage of, alongside some unique positioning and IP and systems and processes that would be valuable beyond just the revenues that you generate. I think that's kind of the holy grail, because revenues, if we're looking at an exit and selling your shares, you'll get a multiple of your revenues or a multiple of your profits. And depending on how big that multiple is of your profit will depend on factors like the value of your intellectual property, the value of your systems and processes, the value of your brand in the eyes of consumers, and the market. The market positioning you have against your incumbent rivals. All of these things will determine whether you get 3x profit, 10x profit, 15x profit when you sell. So think about how you position this, not just as an e-com business that's selling stuff and can generate huge revenues, and we've got service providers in place that can deliver a lot of the fulfillment and shipping and handling, but actually how are we building valuable IP and value around the business, not just generating revenues and profit. So that's the key, I think, for the majority of investors, and that, whether that's an ecom platform or whether that's a fintech SaaS, I think those rules apply.
Yeah.
But I think where ecom brands probably fall short most is focusing on sales and marketing and just growing revenues with investing as little as possible into operational costs to improve margins, and therefore not talking enough about systems, processes, value, a valuable entity, and just too much focus on revenues and profits.
Okay. And final question before we round things off. What would you say about the economic conditions that we're facing and how that's impacting what businesses you're seeing are achieving in the market?
Yeah, so we've got Trumponomics happening right now, and the various trade wars that are pursuing. We've obviously got a Labour government as well, which has completely changed the narrative from the sort of conservative mantra of it's all going to be fine, everything's fine, it's all right, don't worry about it, to sudden switch overnight to things are dire, it's going to get worse before it gets better, and that's obviously affecting consumer confidence. It's the same economy, but bar a few months, but a completely different narrative around it. So those two things are obviously having an impact on how consumers feel and how small businesses and startups perhaps feel. I've been doing this long enough to know that these things tend to kind of come and go and are a flash in the pan. So I've been doing this for about a decade now. So we've seen we've seen COVID, we've seen Brexit, and then prior to that, there was the global financial crisis, which we weren't in business, but I know the data around. So in all of these instances, the global financial crisis, COVID, and even more locally with Brexit, in every single one of these big economic events, they have resulted in stock markets crashing and startup investment going up. So after the global financial crisis, we saw startup investment go up something like 30 to 50% year on year for the next 5 or 6 years. And that's early stage investment. COVID saw the year 2020 and 2021, we saw where we were doing about 20 odd billion a year in startup investment across Europe. That ended up being 60 or 70 billion during the lockdown years. And Brexit did the same. We saw the pound plummet. Everyone was worried, and a load of inward investment came in, and startup investment went up. I can't remember the exact figures, but it went up. So for me, my mantra right now is great. Carry on, Trump. This is going to be great for our clients. But obviously, we don't know. But history tells us that there's no point putting the money in the stock market right now. It's too volatile. Wealthy individuals need to put their money somewhere. And most angel investors know that the best time to invest in startups is during the down times, because then they can exit in the up times and get an even bigger impact on. They can invest now when valuations are squeezed, and they can exit when valuations are booming in 5 years' time, because the economies tend to go through a sort of an 8 to 10 year cycle. So most investors I speak to aren't too phased. These things don't affect whether or not they invest. What they affect is the sorts of returns they might expect and the sort of deal terms they would do the deal on. Doesn't stop them wanting to invest, because they can't stick their money into the stock market instead, because they're not going to get, it's too volatile. They're not going to get the same level of returns putting it into property. So they've got to carry on doing what they're doing. They just might change tack slightly with the deals, but it doesn't stop the money flowing. I think last year we saw more or less $30 billion invested across Europe in early stage funding. The majority of that is in the UK. We tend to have, out of the top 20 cities across Europe, we tend to have 8 to 10 UK cities in there. I think London does as much funding in London happens as across Paris, Berlin, and Stockholm or somewhere combined, the next 3 biggest tech hubs. So most of that money is invested in the UK, and it was 30 billion last year. That's 45% up on 5 years ago. So we're seeing increases. There was the COVID period where it was 60, 70 billion, but we're still at 30 billion. If you're raising 150k and you can't find that in a pool of $30 billion, something's seriously wrong, I think. So yeah, they're huge figures, crazy figures, and it's a huge amount of money out there for startups to have access to.
Perfect. James, that brings us to the end of today's episode. So I just want to say thank you so much for coming on. I've learned a lot, and I'm sure the listeners have too. Where can people that want to hear more, where can they find you?
Yeah, so you can connect with me on LinkedIn, James Church on LinkedIn. Give us a search. I'm sure you'll find me. You can go to pitchready.co.uk if you want to kind of test your sort of benchmark your ability to raise investment. We can test you against our methodology and see where you stand. You'll get a free written report on kind of giving you tips and advice on how to get more investor ready, and you'll also get a link to order a copy of my book completely free as well. So if you want that little sort of bundle of goodies, just go to pitchready.co.uk, take the assessment and get access to the sort of bonus content in my book. So yeah, that's probably the best way to kind of start the journey and figure out more about all this stuff.
Cool. Well, James, thanks again. I really appreciate you taking the time.
Lovely. Thank you, Jordan. It's been a pleasure.
Scaling an ecom brand is hard. That's why we're on a mission to share as much info as we can to help make it easy. From weekly interviews with the biggest names in the space, to case studies, brand breakdowns, and tips and tricks, and much, much more. Subscribe so you don't miss out.